Hello everyone, welcome to OptionGig. This is your host Vivek, part-time option trader and full-time worker, husband and father. If you also want to generate consistent monthly income trading options while working in your regular day job, then join me in this journey. Okay folks, the recording is on. Okay, so this is a normal profile of a retail trader. If you are just buying stocks or selling stocks, means your probability of profit is 50%. At any point of a time, stock can either go up or can go down. And if you bought, in this example, if you bought the stock at 190, if it goes high, you make money. If it goes low, you basically lose money. And so our probability of profit in that case is 50%. Now, if we have to gain an edge in any system, what do we need? We need, to be successful, we need an edge. Now we'll have to find out how to get that edge. Now, using an edge in our option trading, we need to find out strategies that will push the theoretical probability of profit at more than 50%. Right? Like I said, buying stocks gives you 50% probability of profit. But if we can find a ways which pushes the probability of profit to more than 50%, that will give us some edge in this business. Then we can also find a ways to manage it so that the actually probability is either closer or higher than 50%, right? I don't want to be satisfied just with the coin toss, which is 50-50. So first I want to start by giving myself higher probability of profit. And then I want to run the business well so that if I'm starting with a 60% probability of profit, I actually up the odds in my favor and make the business to give me 75% probability of profit. And the idea is we do this repeatedly, do this often, and make sure we also have a risk management so that if there is any losing trade, it doesn't wipe us out. It still keeps us in the game, right? There is no free lunch anywhere in any business or not even options trading. So if we are defining trades that give us higher probability of profit, we are taking higher risk. Or we can do the trades that give us very less probability of profit, but and give more money. But the question is, you are looking or shooting for stars at that case, or trying a lottery ticket. So we want to ensure that we do high probability, which means a little more risk, but have a good risk management practices that if we get some losing trade, it doesn't wipe us out. We are still in the game. So that's what we're going to talk about in today's session. So before we jump into it, and I think before we started the session, somebody asked about Berkshire Hathaway. So we look at businesses like Berkshire Hathaway and find out what's its edge in the long term. Now, if you look into Berkshire results, in some years they have trailed S&P. In some years they have way surpassed S&P. But over a long period of time, I think over 60 years, or I actually talked about Berkshire Hathaway and its results, I think in one of the podcasts and on YouTube, where we looked at what are some lessons from Berkshire annual letter to shareholders. Yeah, so from 1965 till 2019, Berkshire Hathaway has returned 2,744,062% gain, compared to S&P, which has returned 19,784% gain. But that doesn't mean that Berkshire has been beating S&P every year, but they have an edge. And they also make sure that one bad year doesn't wipe them out. So what's the Berkshire Hathaway's edge? Now, if you really look into their business model, they are heavy into insurance. Berkshire Hathaway owns Geico. They own General RE, which is reinsurance. They also have lot of specialty insurance. They have a medical insurance. They own national indemnity primary group insurance. So they have a lot of insurance businesses from which they get a lot of float money. And then they deploy the float money into various businesses, which Warren Buffett thinks that those are undervalued. So if you listen to Warren Buffett, he says his main job is capital allocation. They get tons of money through options, through their insurance premium. He just allocates money to the right businesses. And that's why in Berkshire Hathaway corporate office, there are only 26 employees. Because their job is just to manage the capital. So Berkshire is big in insurance, but that's okay. But how does insurance related with options trading is what we're going to look at. Can we do the same thing what these insurance companies do to make money? All right, so basic premise of insurance business is people generally overestimate for risk, right? And insurance company, they have actuarials who know what exactly are the statistical probabilities of the risk happening. And based on that, they define the risk premium. Now, once, as an insurance company, they know the risk, they define the premium, and they collect the premium upfront. And they also sell these policies to thousands and millions of people because those probabilities only play out over a large number of instances. Okay, might be getting a little heavy, so I'll probably try to explain it taking real life examples. So if you toss a coin, your probability of head or a tails is 50-50. But that does not mean that if you toss a coin 10 times, you'll get 5 heads or 5 tails. You might get 7 heads, 3 tails, or all 10 heads. But we know that if you toss the coin 5,000 times, 10,000 times, you're getting closer and closer to 50-50 chance. So that's what insurance do. They know what's the statistical probability of a risk occurring. They also know that people are willing to overpay for the risk because the risk is generally overstated. And they also know that for them, for those risk numbers to work out, they need to sell millions of policies. So what they do, they will try to spread the risk over as many policies as possible, because then the probabilities start to work in their favor. If there's a company which sells only one type of insurance, hurricane insurance, only in an area which is impacted more frequently by hurricanes, they may get wiped out. But if they sell to that same insurance to millions of people, and also in an areas where the probability of happening hurricanes is less, then the statistical probabilities will work out. Okay. All right, so what's a similar thing of risk, which is in options? So the risk in the stocks is represented by volatility. And also we have seen that the risk induces fear among market participants, means of the on March 23rd, when the stock market fell down, volatility was through the roof. The index VIX, which is called the volatility index, is also known as fear index. And the VIX had shot up to, if I recall correctly, to almost, I think, 85 or something. That was the highest level since 2008 crisis, because there was so much fear in the market. And that fear is what we have seen over and over again, that it is overstated. People think that it's gonna do a lot more damage than it actually does in the long term. Okay. So for us, that volatility or the risk is our source of our edge, because now we have found out something that over a long period of time we know is overstated, is overpriced. Now, what does this volatility means? The implied volatility is a measure of what market thinks or implies about stock movement. This is forward-looking, means the market participants think that the stock is going to make X% up or down, and that defines the implied volatility of the particular stock. Now, visually, let's say there's a blue stock and a black stock. There are two stock tickers. By looking at this image, you can clearly see that the blue stock is a lot more volatile than the black stock. Even though if you average out their price, they may come out to be the same as $100, but clearly the blue has a lot more volatility than the black stock. So kind of just to give you a reference of how to think about volatility. It does not tell us about the direction in which stock may move, but just the fact that the stock makes a lot larger moves. If it is, and then that case, the volatility is much higher. One stock that we are seeing is always in high volatility is Tesla. It shoots to the roof. It goes to the pit of, the bottom pit, depending on what Mr. Musk tweets. Whereas we have also seen, most of these ETFs, because they have hundreds of stocks in them, are generally less volatile. Okay. So now, because I said that implied volatility gives us an edge, because we know it is overstated in long term, or it is overpriced over a long term. So what we plan to do, or that's what I do, is I sell volatility, because then I know I am selling something which is higher priced. So, but if you buy volatility, then you're paying more premium. If you're selling volatility, you're collecting more premium. In fact, so I remember on March 3rd week, on some of the stocks, the premium that was available was as high as 30% of the strike price. But now the same stock, same strike price, even the stock is also at the same current price, which it was in March, premium is just 10%. Because on March 23rd, near that, the volatility was so high that there were a lot more premium available. So if you buy a option at that time, you're paying a lot more premium than if you buy right now. Or if you sell options at a high volatile environment, you get a lot more premium than when you sell at a low volatility environment. Okay, so fine. I think, again, still the question is, where is my edge? And like I said, edge is that it lies in volatility, which is generally overstated and overpriced. And that's where we derive our edge from. I think, like I said, where long-term it is overstated, premium that paid out is more than the protection that it provides. That's what I mean by overstatement. Let's say we talked about in our pop quiz that when you buy a put, you are buying an insurance, thinking that that insurance will help you when the market goes against you, and it will help you to protect your portfolio. But if it's on a long term, studies have shown, and I think I talked about in session 3 that if I get time, I'll basically do an analysis of a study that was done in Europe, where they talked about what are the portfolio protection strategies and which one actually works. So buying a put was the worst one. Because again, the fact is that the risk is overstated, you end up paying a lot more premium than the protection that it provides to your portfolio. We'll see visually also that how IV or implied volatility is overstated in long term. I want to emphasize it again that whatever we are talking today is applicable only in long term. There will be, and there have been, scenarios for shorter duration, like let's say what happened in Feb and March end, that the implied volatility was understated. But then you don't know when those periods gonna appear. So over a long term, the implied volatility is overstated. Within that long term, let's say over a decade, there may be some shorter durations wherein it is understated. But we are in this game for a long term. So we look at how the long-term behavior happens, and we basically define our strategies based on that. So here's one, and again, this is from a Tasty Trade. They do a lot of back testing and publish a lot of studies. So this is one study wherein they looked at from year 2004 all the way till 2017. What's the implied volatility of S&P 500, which is represented by this VIX, and what actually happened? How much did the SPY actually move? So if you look for all the last, over the 13-year period, there are only 2 years in which the realized volatility, means the actual movement of SPY, was higher than what people thought it would be. In all the other cases, people thought that the stock will move a lot more than it actually moved. And 2 years where it did not, where the implied volatility was not overstated, one was 2008, and we all know what happened in 2008. And then another one was 2017. And I'm sure if we run the data based on till, end of April 2020, we'll add one more year, 2020 over here. But over a longer period of time, if you really see, there is always the fear or the volatility, implied volatility represented by VIX is always overstated. So we do have an empirical proof of overstatement of risk in the market. Again, this is a graph of Dow Jones Index. We talked about S&P 500 in the previous slide. This is the Dow Jones Index. The implied volatility is represented by the teal color, and the actual volatility, or the realized one, what actually happened in Dow Jones Index, is represented by the yellowish line. Again, as you can see, for most of the time, the yellow is below the teal. Stocks, Dow Jones Index did not move as much as people thought or market participants thought that it would, except a few instances here and there. Okay, so that's what I mean by that. The IV, or the volatility, is generally overstated over a long period of time. There will be pockets, there have been, and there will continue to be some pockets where it will not be, but over a longer period of time, it is generally overstated. Now, that's what gives an edge. Now, the next question is, okay, we have seen the graphs, I understand that the risk is overstated, and so the implied volatility is overstated. But what has it to do with the options trading, right? We haven't yet talked about calls and puts, and gain and edge via calls and puts. So how is it related to options trading? And that came in one of our pop quiz. It is related because the option pricing is determined by implied volatility. So we talked about it, that our extrinsic value of an option pricing is determined by days to expiry, volatility, and interest rate. So now if we know that volatility over a longer period is overstated, is overpriced, it means the option pricing over a longer period is overpriced. Now, those who want to geek into it, this is basically a option pricing formula for a call option, for a put option. please don't ask me to explain this. The economist won the Nobel Prize for it. So I am nowhere near closer to explaining how the option pricing is determined. And I don't have to bother about option pricing because, the trading platform shows me what the pricing is. If I'm a market maker, then I might think about these things. But as a retail trader, we don't have to worry about it. The only reason why I put this over here is the sigma, which denotes the volatility. You can see that when you calculate the implied volatility, you do have, when you calculate your option pricing, let's say for call option pricing, your blah, 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 blah into D2, where you have a sigma, and again for D1, where you have a sigma, which is volatility. So volatility does play a role in option pricing, and hence we know if it is overstated. So the option pricing is overstated. Now, if you sell something that we know is overpriced on a long term, that's where our edge lies. Now, like I said, there is always a trade-off. The trade-off is that you limit your upside. But we have seen that even if we limit our upside, but if we gain that edge, and we do this often multiple times, that's where, on a longer period of time, that gives us an edge. But if you buy something which is overpriced with a low probability of success, we might hit once out of the park. But over a longer term, that's a losing proposition, like a lottery ticket. Somebody might have bought a lottery ticket, would have made money, but you can't make it living buying lottery tickets every day. Okay. The whole idea here is to put the odds in our favor. For us to put the odds in our favor, we want to do the trades that give us higher probability of success. Repeat it often, because we know the probability of success is theoretical and it only works over a longer duration, or over a longer occurrences. So we'll look into it, on how do we increase those number of occurrences. And that's essentially is what our game plan should be if you are planning to trade with options. Be a net option seller. That doesn't mean that we don't ever buy options. So if you have noticed some of the, I think very few trades which I do is as an option buyer, and I very specifically mention when I share that with you that, hey, this is my lotto ticket trade. This is a lottery ticket, because if it may work, most of the times it will not work, but the stock which I do is the Tesla, because hey, it defies all probabilities. But I'm net option seller. We may buy, sometimes if I buy an option, it is in combination of my option selling trade. Be an insurance company, right? We as a consumer pay a lot of premium to insurance companies, but who wins in the long term? It's an insurance company. They make tons of money, and not the consumers who are buying those insurance. Okay, so that's in a sense is should be our game plan, is be net option seller, because being an option seller provide us an edge. It does come with some risk, but we need to understand how to manage those risks and still be in the game. Okay. Now let's review other benefits that accrue to us if we are net option sellers. All right. So we talked about that in option trading, there are more than one ways to set up a trade, right? If you are a bearish on a particular ticker, you could either buy a put, which is this long put, or you can sell a call. Both of them kind of express a bearish opinion. Or if you're bullish, you can sell a put, means you can short a put, or you can buy a call. both are bullish. There are more than one ways in which you can set up a trade in options. In stock, that's not a case. There's only one way. So let's look at a bearish scenario, and then we'll see what happens to option seller versus option buyer. Oops. All right, so for a bearish, stock is as 125, and you take a strike price as 125. So if you buy a put, as an option buyer, you only make money if a stock goes low. Okay, all right. Yeah, so you only make money if a stock goes low, but if you sell a call, you make money even if stock doesn't move at all, or it moves, it has a minor movement even if it is against you, or if the stock goes higher. Let's look at how we can represent it in a picture, because picture says 1,000 words. So left side, we are buying a put. The strike price is 125. I'll only make money if I buy a put if a stock actually goes down. It goes below 125. And of course, it has to move way below 125 to cross my break-even point. But if a stock stays as 125 or goes higher than 125, as a put buyer, I'm not making any money. But if I sell a call and the stock stays as 125, I'm still making money. If a stock goes higher than 125, I'm still making money as long as it doesn't go too high. So as an option seller, we are actually profitable in 2 scenarios out of 3. But if you're an option buyer, you're profitable only in 1 scenario out of 3. Okay. This is similar is for a bullish outlook. Let me just quickly skip over here. Same, if you're a bullish on a stock, either you can buy a call or you can sell a put. When you buy a call over here, your break even is 125. You only make money if stock goes high and go beyond a break even point. But if you sell a put, you make money if the stock goes high or stock stays the same, or if it goes a little low, you still make money. Now, like I said, the catch here is if you have a call, you have an unlimited profit potentiality. That doesn't mean you'll always get unlimited profit, but potential is unlimited. In this case, you're limiting your profitability. But I would like to have higher chances of making money, even if I'm making a little less money. That's what I do in my job. I have more probability of making money through my job. And I know that I'm limiting my amount that I can make through my job. But I have almost unlimited amount to win if I buy a lottery, but I know the probability of hitting that jackpot is very less. So what I do? I choose to go to my job and not buy lottery tickets. Same thing I try to do with options, because that's where our edge lies. So summary is option seller can win 2 out of 3 scenarios of a stock movement. Either the stock cooperates and move in the direction of your outlook that you had, or it stays the same, or move a little bit lower. As an option seller, you still win. So we have a higher probability of winning. When the start, we actually push the probability of winning by more than 50%. Next one, other way is option sellers, they have a margin for error. I think by now, this probably is clear. We are in session 4 and I've talked about this, I think in almost every session, that if you buy an option, you immediately start to lose money if stock doesn't cooperate. There is no room for error. But if you sell an option, there you also have a margin or a room for error. You sold an option here, stock goes against you, but as long as it doesn't go more than the premium that you received, you're still profitable. So even if your outlook turns out to be wrong, you were wrong in your analysis, you still have some buffer, some margin of error when you're selling an option. But if you're buying an option, you have zero margin for error. And in fact, stock has to make a lot bigger movement for an option buyer to make profits. Okay. So like I said, option selling can be profitable even if the stock moves in opposite direction of trade assumption. And I think I can't recall, was it session 2 or session 3? We took an example of a couple of trades wherein, oh boy, I was horribly wrong in my stock direction picking. And I generally don't pick directions, but sometimes, yeah, I do think that, stock will go high or go low. And I put option trades and I was wrong. But we were still able to exit the trade for profit. That would not have been a case if I was buying an option. Only option selling can provide you with those opportunities. Third thing, we all know that the time impacts option pricing. So let's understand the impact of time. One thing is universal truth: time will always move forward. That will be true, until time machine is invented. But we'll see. So we know that time always move forward. And in that case, if we really look at the chart on the right side, the option value decreases with time. So on the x-axis, you see how much is time remaining until the expiration, and what is the option value component that is determined by just the time, right? We talked about it, that days to expiration is one part of the extrinsic value of an option contract. The point that I want to highlight here is that as we get closer to expiration, that component of the extrinsic value keeps on declining. And when you are hit expiration, it becomes zero. Your time value or extrinsic value becomes zero. So if I buy an option here, I'm actually buying something which I know will decay over time. Assume everything else stays the same. Your stock price doesn't move and your volatility doesn't move over that, let's say, 30 days period. Even in that case, the option pricing will continue to decline because of the what's generally termed as a theta decay. So if I buy an option, I'm buying something which I know will decline with time. I would rather sell that thing because I know, hey, I'm selling at something which has some value, and the value will get closer to zero, when the option expires. So the universal truth that the time always move forward is on the side of option sellers. As an option seller, the passage of time is our best friend. For option buyers, that's their nemesis. Okay. All right, we talked enough of why our game plan should be to net option seller to stay in option trading for a longer period. And the trade-off that I mentioned was that you are limiting your upside. You no longer have a 0.1%, 0.001% of making $1 million. But you have 80% chances of making $1,000. We are limiting our upside. Now the bigger question is there a proof that this really works in long term? Or is it just theory? So now let's look into the evidence. I'll quote Tasty Trade because they do a lot of back testing. So we're going to look at an empirical data from 2009 to 2018. We're going to compare S&P 500, and we will see, we'll look at both the scenarios, that if I'm a bullish, then what can we do? And if we are bearish, then what we do? We have two ways to express bullish as well as bearish scenarios. We can either buy options or we can sell options. And let's look at what the data is telling us. What's the right way to express that sentiment? So the time period that we took is 2009 to 2018. If we have been involved in markets, we know that this was one of the longest bull run in the US market's history, right? Almost a decade of bull run. Market has been grinding, slowly only in one direction. Mostly it was a unidirectional movement, just going up. Of course, there will be some pockets where it will go down over some period of time, but if you if you look at the direction, it's been mostly up, and that's why it has been the longest bull run in the US market history. So if we buy a call option, which we know profits if a market goes up, it should be profitable, right? If you have any questions, please post it in the chat window, right? So, and that has been the case. Okay, for now, I'm not going to talk about what does this 50% mean. So let's focus that we buy an option and let it go through the complete expiration period. So if you had bought an S&P 500 options, a 30 delta options, for which is 45 days away from expiration, your success rate would have been 30% and your average profit would have been $8. Even in the bull market, which, I mean, you're making money, you're not losing money. It's been a bull market for 10 years. Market has been cooperating in our direction, where we are buying calls, and we are able to make some money. So that's good. But what is even better is if you had sold a put. If you had sold a put, your success rate was much higher and your average P&L was way more than by buying a call. And the reason is, number one, higher probability of success. Number two, the initial premium that you get gives you a cushion for the time when the stock goes against you. And in the long term, eventually we end up making a lot more than just buying a call. If you buy a call, stock need to do a lot more work to make money for you. But if you sell a put, even if stock doesn't do anything, you still make money. You only lose money if a stock goes against you by a lot more than the premium that you gathered. Okay. So this was a bullish case wherein I've been bullish on S&P 500 in 2008. So question from Spot is, what are the Greeks of that put sold? So the delta is, it's a 30 delta. It's 30 delta, 45 days to expiration. So I lost my chain of thought. Yeah. So this was when the stock has been cooperating for 10 years. Of course, with the ups and downs, we know that stock never go in one direction. They go up and down, but the general trajectory was moving higher. Even in that case, we found that the short put way outperformed the long call. Now let's look at it, even if we were bearish on it. I hope no one was bearish on the market, because if you were bearish on the longest bull run, obviously we'll be losing money. So when you are bearish means you buy a put, because I'm bearish, I think the stock would go down. In that case, we obviously will lose money because the stock didn't cooperate. But if we bought put, we would have lost on an average $80. But if we had sold call instead of buying a put, we lose money because stock didn't cooperate, but the average loss is way less. So in both cases, even if we were bullish on S&P 500, or even if we were bearish on S&P 500, in both cases, the option selling strategies came out much better than an option buying strategies. Were there instances where the option buying way outperformed option selling? I'm sure there would be some instances, right? But those are one-offs. Now again, this is a continuation study of selling 30 delta options, 45 days, and you keep on doing it. Now let's think back and go back to, few slides where we talked about the probabilities, right? Say instead of doing it over and over again, if I'm only doing it, near, let's say, earnings season, or only once in a while, then those are not enough instances for probabilities to work out. Then you may end up like a lottery ticket. You bought a put, hey, you made a lot of money because earnings were announced, stock tanked. You think that you've kind of nailed down how to make money on options, but next earnings season you buy a put, it expires worthless, and you do it over and over again. So again, it's a long term game, or I'm saying it's a long term business. If you want to be in options, you need to make sure that you do enough trades to let the math work out behind it. Those Black-Scholes and Morton, they haven't got Nobel Prize for nothing. There is a whole math behind this whole option pricing, option premium pricing, and all that we are trying to do here, right, as I'm trying to do, is to just make sure that the math works in my favor. Means when I put a trade, it needs to be higher probability trade. Then I need to figure out that how to make sure that actually those probabilities happen in the life. Means I need to increase my instances. So instead of doing, if I have $1,000 available to trade, instead of putting 2 trades with a $500 risk in each trade, I would rather put 10 trades with $100 risk in each, because I am increasing the probability, I'm increasing the instances or increasing the occurrences, which will make sure the higher occurrences I have, the probabilities will then work out. If you toss a coin, it may not work out on the first 10 tosses, but if you toss it enough, the probabilities will work out. And that's why I'm very particular about how much is that I'm willing to risk on any particular trade. And there is another math behind it. Actually ran some probability calculations to figure out what's the probability of wiping out the account if you do not let any trade more than 5% of your overall capital. It is very, very, very less, almost nil. The people who blew up their account is because they get too big in their sizes. We'll talk about that in some other session. There's a completely different session I'll have on what are the things that we need to do to stay in this option trading for long term, where we'll look at some of those. All right, so that's all I wanted to talk about in terms of how to gain an edge if we are in options. Quick takeaways: we learned that the IV or volatility is overstated over long term. Definitely it was not overstated from February till April, but if you expand our horizon, if you expand our timeline and look at last 20 years, we'll find that it was overstated. So the option sellers who collect premium is higher than the protection that it provides. We are more profitable in long term. It's like insurance company. They collect in more premium and they pay out lesser in damages. And then they know what's the statistical probability of those damages happening. And then they make sure they sell millions of policies increase the number of instances so that the statistical probability do play out. We also looked at that the option seller can will 2 out of 3 scenarios of stock movement. Either the stock move in the direction of your outlook, great. The stock doesn't move, still fine. Stock moves a little bit against you, you're still okay. You can still win if you're an option seller. We'll also cover in some later sections, even if stock moves more than the premium that you have received, how we can manage trades and still come out net profitable if we are selling an option. And when we do those management techniques, we don't have to put any additional capital. Like I said, option selling is also more forgiving and provides you with a margin of safety. If you're wrong in your analysis, in picking the direction, and I admit I am wrong, I'm mostly in picking the direction, but I then don't have to worry about picking the correct direction always. It is forgiving. It is giving me some margin of safety. And lastly, the time is the best friend of option seller. The time will always pass. And as an option seller, we know that it is beneficial thing for us. All right, so I think that's all I wanted to cover on this game plan session. Now, other thing that we wanted to talk about was what are the things that we can do as a option trader with a smaller account size. But before I jump onto that one, if any questions, please unmute yourself and we can go through some Q&A on this particular section. Please note that all the information presented is purely for educational purposes and is not a financial or investment advice. I don't know you, you don't know me, so do yourself a favor and don't invest or trade solely based on what you hear.